not even thinking about raising rates. We're totally focused on providing the economy the support that it will need. We think that the economy will need highly accommodative monetary policy and the use of our tools for an extended period. And we're absolutely committed to staying in this until we're very confident that that is no longer needed. And what we mean by that is pretty straightforward. It is we'll want to see that that the labor markets have moved, labor market conditions have moved, have made substantial progress toward maximum employment, and inflation has made substantial progress toward the 2% goal. That's what we're going to want to see. Now, that obviously includes an element of judgment. And when we see, we'll be carefully looking ahead. We also understand that we will want to provide as much advance notice of any potential taper as possible. So when we see that we're on track, when we see actual data coming in that suggests that we're on track to perhaps achieve substantial further progress, then we'll say so. And we'll say so well in advance of any decision to actually taper.
Becky?
916,000. Wow, that's the actual number. Rick, you win. You're the closest.
Yes, unemployment rate edged down to 6%. And then I got to go find the B1 tables to find out where the jobs were. But it looks like finance activity, retail trade up 23,000, wholesale trade up 24. Let's see where else. Transportation and warehousing up 48. Manufacturing, that's been on a tear, up 53,000 here. Construction, sit down for this one. I don't think I've ever seen a number like this. Added 110,000 jobs in March.
What we're really saying, though, is we're no longer going to raise interest rates just because, for example, if unemployment were to be well below our current estimates of the natural rate of unemployment, that wouldn't be a reason to raise interest rates unless we see troubling inflation or other imbalances that could threaten achievement of our mandate.
Hey, Joe, raw material costs, that's what it's all about. And we wanted to see exactly what raw material costs are doing to the price of automobiles in terms of what the automakers are dealing with. Check out this chart. This is due according to data from Alex Partners, a consulting firm just outside of Detroit, works with the auto industry. We are at an all-time high in terms of raw material costs, up $1,152 compared to the averages of last year, now at almost $3,000 per vehicle in terms of raw material costs. And when you break it down, some of those raw materials, they have just exploded in the last year. Platinum metals, mainly we're talking about rhodium, up 135%. Steel has doubled in price. Copper, aluminum, they're all shooting higher. In fact, we found maybe one or two raw materials that are at the same price or slightly lower. Everything else is up.
In seeking to achieve inflation at average percent over time, we are not tying ourselves to a particular mathematical formula that defines the average. Thus, our approach could be viewed as a flexible form of average inflation targeting.
She can stay afloat with the first 4 compartments breached, but not 5. Not 5. As she goes down by the head, the water will spill over the tops of the bulkheads at E deck, from one to the next, back and back. There's no stopping it.
The pumps. If we open the doors...
The pumps buy you time, but minutes only. From this moment, no matter what we do, Titanic will founder.
At the Fed, we will continue to provide the economy the support that it needs for as long as it takes.
All right. Today is Sunday, April 4th, and this is a post-market review for the stock market activities last week and an outlook for this upcoming week. Happy Easter! I hope everybody had a very good trading week. It was a short one, but nonetheless packed with action. And I gotta tell you, it was a bad week for me. Oof, what a beating I took this week. It was a bad week. Oh, I'm sorry, what was that? How bad was it? Is that what you're asking? asking how bad was it? I'll tell you how bad it was. It was so bad, Bill Wang of Archegos Capital called asking me if I need a loan. Oh, it was rough out there. This week I bought the dip, I ended up having diarrhea. Anyways, enough with the funnies and let's get to business because we have a lot of business to discuss. Entering this week, we had 3 major events to watch for. Number 1, the portfolio rebalancing from hedge funds, pension funds, and the likes. And the expectations were that these funds will buy bonds and shuffle some of their stocks holdings. The other event we were watching for is the unveiling of the infrastructure bill. And the expectations were that once the market realized that the price tag for the infrastructure bill is too high, yields will climb higher, we will see infrastructure/inflationary stocks rising higher, meanwhile the Nasdaq and the growth names diving lower. Now that did not happen. What happened was the opposite. We saw the Nasdaq and the growth names catching a bid. Meanwhile, we saw a mini baby sell-off in the inflationary names and the infrastructure stocks. At least the traditional infrastructure stocks. We're not talking about solar, EVs, etc. because these stocks actually caught a bid this week. Now, the third event we were watching for was the March jobs number. And boy, that came way better than expected, signaling an economy that's about to heat up significantly. Now, the market did not necessarily react the way we were expecting it to because, as I mentioned, yields actually traded lower. We saw the growth stocks, in addition to the Nasdaq, scoring significant gains this week. So what's up with that? What do we see looking forward? To answer that question, we have to go back to the 2 directions that the market is debating taking. And of course, I showed you this slide before, the 2 directions, the Dow versus the Nasdaq. And some people complained, oh, but Apple is in both and Microsoft is in both. This doesn't make sense, etc. So here it is, kids. Fixed it for you, made it more clear. The 2 directions. Number 1, the inflationary/reopening route, where we see yields surging higher, the reopening stocks, reinflationary stocks, and value stocks catching a bid. The other route is the deflationary route, in which we see lower yields. We see technology, reopening, and growth stocks outperforming. Now, given the action that we saw this week, the shortened trading week, we cannot make a solid conclusion because, yes, the action favored the deflationary route, but we know it was a shortened trading week with lower volume. In addition, it was distorted by portfolio rebalancing. So the question is, how will the market react this upcoming week when the adults are back in charge? Will it choose the inflationary route or the deflationary route? Because you cannot go both ways. You have to choose direction here. What are the facts supporting each direction? This is what we're going to discuss during this video. I have all the facts for you, all the information, and then some. But before I start the coverage for the market, here's another thing we have to review. The 3 dynamics controlling the market right now. The virus, inflation, and treasury yields. And they're all linked in a chain, step by step. To unlock inflation, you have to defeat the virus first. To unlock treasury yields rising higher, you have to have inflation first. We know the factors impacting the virus. On the positive side, we have more reopenings and we have more vaccine progress by the day. Meanwhile, the glass half empty side says that we have rising cases of COVID-19 overseas. We have more lockdowns, specifically in the EU, and there is the possibility for the black swan event. That could be the Brazilian variant or any other variant that can bypass current vaccines and perhaps have a higher mortality rate. Now, the market is assessing these factors and the flow of news every single day, and it is deciding to unlock the door of inflation because the glass half full side of the argument is more dominant for now, and therefore we move on to inflation. What are the facts supporting inflation? We have higher commodity prices, we have an insane surge in money supply, and we have higher demand on goods and raw materials, and that's impacting shipping rates and many other factors, pushing inflation higher. What are the factors working against inflation? Number one, the recent bounce we saw in the US dollar and the devaluation of foreign currencies. That is pushing the value of the US dollar higher. If the US dollar continues to surge higher, that acts as de-inflationary pressure. Now, we have another factor working against inflation, which is the velocity of money, or rather the absence of the velocity of money. That is expected to pick up as soon as we start reopening more and more and more. Money will start exchanging hands, and we will see the velocity of money speeding up. So far, the market is saying we have enough progress regarding the virus to unlock the door of inflation. We have enough supporting facts to unlock the next step of higher treasury yields. What is supporting treasury yields to continue to stay elevated and march higher by the day? Number one, higher inflation expectations. Number two, the economic recovery, quote-unquote recovery, which is, by the way, a zombified economy being stimulated artificially. But anyhow, on paper, it is an economic recovery. The only negative factor impacting treasury yields is the potential of Fed manipulation of the yield curve. We know we're not there yet, and we have enough facts supporting treasury yields to continue to surge higher. So the question is, will we revert back to the same playbook for the last few weeks once we reopen the market on Monday? Meaning the inflationary trade being in favor, meanwhile the Nasdaq/technology/deflationary side of the market not in favor. This is the question that we will attempt to answer during this video. With that being said, I do have a market to cover. And here we go. The Dow Industrial Average closing in the green with 171.66 points, or a gain of 0.52%. The Nasdaq closing in the green with 233.23 points, or a gain of 1.76%. The S&P 500 closing in the green by 46.98 points, or a gain of 1.18%. And what about the sector's performance during Thursday's session? Leading the pack at number 1 and capturing the gold medal, technology at number 2 for the silver, communication services at number 3 for the bronze, real estate. Meanwhile, the only lagging sector during Thursday's activities is basic materials. Let's contrast that with the performance for the entire week. Leading the pack at number 1 and capturing the gold medal, technology at number 2 for the silver, communication services, and at number 3 for the bronze, consumer, cyclicals. Every single sector of the market managed to close in the green. So we saw overall buying during the portfolio rebalancing, but the message is not clear. Which route did the market take last week, and is it sustainable? We're talking about the inflationary versus the deflationary side of the market. The deflationary being technology, communication services, utilities versus the inflationary side of energy, industrials, financials, materials. We don't have a solid conclusion yet, but perhaps we can gain more insight from visiting the futures market performance on Thursday. And here we go. Remember the axes of inflation: lumber, copper, and grains, in addition to crude oil. Crude oil being the less impactful here because there are specific factors impacting oil prices beside inflation and actual surge in demand. So let's see how the axis of inflation did on Thursday's session, starting with crude oil. Big gains for both the WTI and the Brent index, closing over 3% apiece. What about softs? Lumber closing modestly in the green, but once again above 1,000. We also saw gains from coca futures with 1 3/4%. Meanwhile, muted activities for both sugar and OJ futures. Meanwhile, the laggards and softs futures led by cotton and coffee. What about metals? We finally saw the US dollar taking a pause. And metals futures, at least from Thursday's activities, are saying that perhaps the rally in the US dollar is over for now, and therefore we saw gains for gold, silver, platinum, copper, palladium, all closing in the green. What about meats? The rally in lean hogs, aka the new tech, goes on. Lean hogs closing in the green. Meanwhile, modest movements for both live cattle and feeder cattle futures. Now, what about grains? Grains trading in the red. We're seeing lots of profit taking here, whether we're talking about soybean, soybean meal, soybean oil, corn, wheat. We saw significant declines here, led by soybean meal futures down over 3%. But the landscape remains very favorable for more inflation regarding grains prices. For example, you guys know that I'm long corn, and here we have more inflationary news regarding corn. U.S. farmers will plant lower corn and soybean acreage than the trade expected, according to the USDA, meaning that once again we will have a shortage of supply of corn and soybeans. Meanwhile, the demand remains white hot, specifically from China. So I am expecting soybeans and corn futures to continue to gain momentum. Moving on to the big casino, the options market, and let's see what's going on here. Once again, the notable thing is the absence of retail traders. The options volume remains muted, signaling a lack of activities from the retail trader side. And we know the reason behind it, because it's not a lack of ammo, because they just got a new round of stimulus. It is number one, fear that the correction is perhaps not over yet, and perhaps we should be more careful with how we participate in the market. Number two, lots of retail traders got slaughtered from the correction the last few weeks. Looking at the NASDAQ, the Dow Jones, the SPY alone doesn't give you the complete picture. But looking at the retail crowd's favorite names, the likes of Neo, Plug Power, Blink Charging, Palantir, ARK Invest, shows you the clear picture. There are a lot of retail traders holding the bag as we speak, and they don't have disposable income to take more risk. Nevertheless, we saw a slight uptick in volume during Thursday's activities, which happened to be the last day of the trading week, which happened to be a short trading week, just in case you didn't know. And the uptick happened in EV names, specifically Tesla and Neo. So let's see what's going on here. The hottest table on Thursday was Tesla, with about 1.3 million contracts. About 62.5% of those were calls. So we have a very noticeable uptick in Tesla's volume. And perhaps traders were placing bets because the majority of the surge happened in the call side. They were placing bets in anticipation of Tesla's deliveries number, which was released on Friday. We will discuss that during the headlines of the day segment. But for now, we have Apple at number 2 with about 1.2 million contracts. About 73% of those were calls. And here is Neo with about 800,000 contracts traded on Thursday. About 71% of those were calls. And also notable, Cisco with about 500,000 contracts, about 96% of those were calls. So a big surge in Cisco call options buying. And I did buy Cisco calls in anticipation that the stock will continue to rise higher. Number one, it is a value stock that should appreciate in value under these circumstances. Number two, the technicals are very favorable. Number three, I am thinking of adding Cisco to my long portfolio. So I am buying calls. And if my strike number is met, we are close to expiration, I will make that decision whether to exercise my options and buy shares of the stock. But how about we move to the unusual activities that took place in the options market during Thursday's session? Let's start with the ticker SPY for the S&P 500. You know, the SPY closing at all-time highs, the VIX closing below 20 for the week, and of course, everybody's having a massive orgasm saying that we have a historic rally that's about to start, etc., etc. You already heard it from the Wall Streeters on CNBC and the likes, and now you are hearing it in the YouTubers community. They are making videos talking about all-time highs and the massive rally that's about to come, even though a few weeks ago they were talking about a market crash, etc., etc. There is no consistency whatsoever. This is why you're watching this channel. We're guided by the facts. That's it. The facts change, we adapt. But back to the trade. Buying SPY puts, aka protection and insurance, is very wise during these times. You don't buy the protection when the market is correcting. You buy the protection when the market hits all-time highs. We saw that happen in February 2020. Matter of fact, if you guys remember, as the market was making all-time highs in February 2020, we saw one massive put options trade on the SPY. And that happened to be the trade that Bill Ackman placed, and he turned a few $1 million into billions of dollars from that trade alone. And here we have a trade for the SPY. They're buying protection by buying the 330 puts, expiration date May 7th, with expectations that the SPY will decline over 17.5% by then. They paid about 40 cents a piece to enter this trade, bringing the total all the way to $1.9 million. And what about the trade for the ticker TGT for Target? In this case, they're making a bullish bet by buying the 220 calls, expiration date June 18th, with expectations that the name will climb over 9.5% by then. They paid about $3.50 a piece to enter this trade, which brought the total all the way to about $3.5 million. And what about the trade for the ticker Triple Qs for the Nasdaq? Once again, they're buying protection by buying the 298 puts, expiration date April 23rd, with expectations that the Nasdaq will decline over 8% by then. They paid about $1 a piece to enter this trade, bringing the total all the way to $1 million. What about the trade for the ticker QS, QuantumScape? We saw these stocks surging higher on the optimism of the new Biden infrastructure plan, which includes creating over 500,000 charging stations for EVs. In this case, they're buying the 55 calls, expiration date April 9th, meaning this upcoming Friday, with expectations that the name will climb over 11.5% by then. They paid about $1.15 a piece to enter this trade, which brought the total all the way to about $700,000. What about the ticker SNOW for Snowflake? They're making a bullish bet here by buying the 250 calls, expiration date April 9th, meaning this upcoming Friday, with expectations that Snowflake will climb over 15.5% by then. They paid about $2.65 a piece to enter this trade, bringing the total all the way to $1.5 million. And what about the trade for the ticker PINS? This is for Pinterest. We have another bullish bet here by buying the 85 calls, expiration date April 30th, with expectations that the name will climb over 9% by then. They paid about $2.40 a piece to enter this trade, bringing the total all the way to $1.3 million. What about the trade for the ticker COF? And this is very interesting because it's not a name that you usually find in this list. And this is for Capital One, by the way. They're buying the 150 calls, expiration date June 18th, with expectations that the name will climb over 15.5% by then, and they paid about $2 a piece to enter this trade, bringing the total all the way to $1 million. I like this trade and I did follow it. Now, what about the last trade for the ticker BABA, BABA for Alibaba? We have yet another bullish bet by buying the 275 calls, expiration date June 18th, with expectations that the name will climb over 22.5% by then. They paid about $2.30 a piece to enter this trade, bringing the total all the way to $1 million. Moving on to the headlines that shaped the week, starting with employment data. We had a lot of them this week, so let's go through them one by one. Now, before we do that, remember that good news is bad news for the stock market, meaning good news for the economy, more jobs created, that is bad for the stock market. Why is that? Because, in case you didn't get it from the intro of this video, good news will mean that yields will continue to surge higher and the Federal Reserve will taper the cocaine operation sooner than expected. And once again, in case if you are a new subscriber, the market cares not about pandemics, civil wars, nuclear wars, asteroids hitting the planet, the extension of humanity. Stocks will continue to go higher so long as the cocaine operation remains intact. What is the cocaine, you might ask? Fiscal and monetary liquidity. Now, if we have a heating economy, that means that the cocaine operation will have to be tapered. Once you taper the cocaine operation from the addict, the market that is, the market will suffer a withdrawal, even though the economy is heating up and getting a lot better. So here it is. First, we got the ADP employment report. This is for the private sector. Payroll processing firm ADP estimated that companies added 517,000 workers in March, the fastest pace since September. Let's stop and ask the question. Is this good news or bad news? It's good news for the economy, meaning bad news for the stock market. Here's another one. Weekly jobless claims higher than expected despite signs of labor market improvement. So first we got the ADP report, and then we got the weekly jobless claims, and they are higher than expected. So we have a little bit of a conflict here. And to settle the conflict, we have the big jobs report that we got on Friday. So how did that look? Here it is. U.S. added 916,000 jobs in March versus 675,000. That was the estimate. The unemployment rate fell to 6%. Now, creating 916,000 jobs in 1 month is historic, and it is a massive improvement, meaning this is good news for the economy, also meaning that it is bad news for the stock market. And right away, without the manipulation that you saw throughout the week with the portfolio rebalancing, quote-unquote portfolio rebalancing, pushing yields lower, even though we're announcing a multi-trillion dollars infrastructure bill that was quickly corrected right after the jobs report, and you saw yields surging higher again, closing above 1.7% for the 10-year Treasury yield. So once again, we go back to the intro of this video. Which direction would the market take once it reopens this week? Given the facts, the massive jobs report that we just got on Friday, yields surging higher, which way, which route do you think the market will take? I'll leave the answer to you. But the devil is always in the details, isn't it? When you peel back the onion, you see the facts. So far, this is the big takeaway. Talking about the jobs report, by the way. The huge job gains come on the heels of furloughed/temporary out-of-work individuals getting re-employed, meaning in leisure, hospitality, now that we are lifting lockdowns and reopening economies. It is not a sign of a hot labor market yet, pulling in those more permanently unemployed. And this is very important, so you have to pay attention here. On paper, the economic recovery is stunning. And the Federal Reserve would say, hey, look at the jobs number on Friday. Our strategy of higher inflation and more cocaine is working because we are recovering the economy. But it's all a facade because in reality, the Fed's cocaine operation and higher inflation are not the contributor behind recovering these jobs. The reopening of states like California and New York is responsible for recovering these jobs. Meanwhile, underneath it all, we actually have an elevated number of permanent job losses, and we're not making progress in that particular number, meaning that we now have a recipe for stagflation. Inflation persisting, but we're not recovering permanent job losses. Stagflation is not going to happen tomorrow, but reading the tea leaves, if these current conditions continue with inflation surging higher, and we're making a half-assed recovery that is impressive on paper but not behind the scenes and in the details, then we are heading to a potential stagflation. And when that happens, all the geniuses on Wall Street and the economists will go, oh, we didn't see that coming. That was a surprise. It's not a surprise. It's right here if you are paying attention. Furthermore, we got the ISM Manufacturing Index. Here it is. U.S. manufacturing sector index races to 37-year high in March, the hottest reading in 37 years. The manufacturing sector is on fire. And we still have inflation. For all of you de-inflationary type of individuals who keep saying, oh, I don't see inflation. There is no inflation. The risk is actually for deflation because of the deflationary forces and the pickup in supply chains, yada, yada, yada. Let's assume that your head is not stuck in your ass, because if that's the case, then you can't hear me. But what do you say about this number? The supply chain is on fire, but it's having a hard time keeping up with the demand. Why is that? It all goes back to the cocaine, the money supply. When you print money out of thin air and you shoot it all over the place, that will create a massive surge in demand because there are so many hands chasing few goods. Classic recipe for inflation, demand pull inflation. And in return, the suppliers will practice supply push inflation to try to tamper that demand. And now you have two forces of demand pull, supply push inflation in synchrony, creating one of the biggest inflation phenomenons that we have seen in many years. What about the housing mania? What's going on with the housing bubble? Here it is. When the pandemic hit, people rushed to buy lake houses and ski condos. A year later, financing those properties is becoming more expensive. You know, the rich went on a splurging spree, and it couldn't be more evident than the sales of luxury cars and boats. Ask anybody in the boats business. The hottest year ever in history was last year for boat sales. But the rich are also scooping properties all over the place to store their money, buying second, third, fourth homes, leading to more inflation in housing prices. Of course, the majority of the money supply, the stimulus and the likes, went in the pockets of the rich, of the 1%. The 1% are not going to sit on the money, save it in a bank, because they're not stupid. They want to create the inflation because it is beneficial to their wealth. So they went on a spending spree, buying stocks, buying commodities, buying boats, buying real estate, all over the place, creating that massive inflation. Meanwhile, we have a huge slice of our society who are under the threat of evictions once the evictions moratorium is lifted. Two Americas, the haves and the have-nots. And the haves are pushing inflation higher single-handedly, paving the way for the phenomena of stagflation. And what about the inflation in commodity prices? Still going hot and expected to get even hotter. And you know me if you've been following this channel for a while. I am a copper bull. I am Mr. Copper himself. I own more copper than the country of Chile, and I've been urging you to buy copper since last summer. And here it is. China has been stockpiling copper at an accelerating clip, helping boost prices and likely making it more expensive for US to accomplish an infrastructure build-out. Folks, this is a war. A cold war between the USA and China. And China is being very smart. They recovered from the virus a lot sooner, a lot better than Western nations. They didn't need to issue a lot of money supply and rack in more debt. They're using their wealth to stockpile on commodities, mainly copper. Why is that? Number one, they need copper to accomplish their expansion goals. But pushing copper prices higher will likely hurt the United States and European nations from catching up to China, meaning that the COVID crisis alone will create the massive gap between the US and China. It always been that the US been leading China, and that gap been shrinking and shrinking, but the US had a comfortable advantage. COVID tightened the gap to become extremely narrow, and perhaps China is already pulling ahead of the United States. And doing this strategy of pushing commodity prices higher will ensure that China will remain on top. That gap will widen in China's favor. Are our leaders even aware of what's going on? The dollar is going down and the renminbi is becoming its replacement for many nations? Of course not. Our leaders are just interested in serving the 1% and the rich, aka their sponsors. They're a bunch of parasites. They want to eat the wealth of this country away, and when the whole house collapses, they will move their wealth over in China, and that becomes their new territory. The only loyalty the rich have is to their own pockets. And with all of this inflation we're talking about, some people are not getting it. They actually have a contrarian view. And our job in this channel is to present to you the facts, fair and balanced, and also represent opposite views. So here it is. Maybe you'll believe this guy. His name is David Hunter, and he says the bond rally has begun. Should see the 10-year yield fall to 1.2%. No evidence provided whatsoever. The next leg of the dollar decline has also begun. Next stop is 85. Either this guy has a crystal ball or he's just pulling numbers out of his ass. The metals are beginning their reversals. Gold headed for 2,500 and silver for 45 to 50. Equities entering a melt-up phase. Nasdaq in gear and headed for 17,000. Wow. Anyways, here's a contrarian view. And I do agree with some of that, by the way. I do agree with the part of the US dollar declining. And by the way, he's talking about metals reversing. Metals been on a stupid cycle for a while now, with the exception of gold and silver. But granted, if the dollar is going to decline, then gold and silver will climb higher. You might say, oh, the decline in the dollar is good for stocks, isn't it? It's good for certain stocks, certainly not the NASDAQ. And here is where the deflationary camp get very confused. They say, oh, there is no inflation because gold is not surging higher. And we know that gold is not a reliable inflation hedge. It says nothing whatsoever about inflation. I will expose that, by the way, in a separate video. But if you are an inflation skeptic, yet you're saying that gold is going to rise higher, then doesn't that mean that inflation will also rise higher and yields will climb higher, meaning that bond prices will go down? You see how easy it is to debate these morons? They can't even stick to one playbook. Anyways, we're moving on to market sentiment news. And perhaps this guy should talk to the market, because in this Bank of America Global Fund Manager survey about the biggest risk for the stock market right now, and it is showing you the evolution of opinion by contrasting the results from March and February. Higher than expected inflation is now the #1 risk for the stock market, up from number 3 only a month prior to the survey. Here we have number 2, a tantrum in the bond market, meaning a taper, tantrum. That is the second highest risk for the stock market right now. And we know that according to the new jobs report, we have created about 1 million jobs in March alone, signaling that the taper is a lot sooner than most expect. But are market participants even paying attention? Of course not. They are overindulged in a massive orgy of mania. And here it is, the average median forward PE ratio for US, UK, and European stocks versus the S&P 500. We have now reached levels not seen since the days preceding the financial crisis and the crash of 2008. What about the sentiment from mom and pop retail traders? Mom and pop have finally, after a year, decided to pretty much go all in. And here it is, mom and pops setting out the rally from last year, and now they're deciding it is the time to join the market, and they decided to go all in. Ask yourself a question. Do you see this kind of behavior on market bottoms or market tops? Very simple question. And here is the S&P price target projection from Goldman Sachs, and it keeps going higher and higher and higher by the day. There's an absolute mania going on in Wall Street, the so-called professionals, and the retail side alike. And here it is, the junk bond mania. Let's chase the riskiest assets, the worst balance sheets, companies with no profits, no revenue. These are the kind of investments that the so-called retail crowd is chasing, the so-called most educated generation of investors. Give me a break. Here it is. As U.S. stocks touched record highs yesterday, investors also plowed into the riskiest debt securities. Relative yields of junk bonds fell to the lowest since 2018 and are just 7 basis points away from post-crisis low. But once again, the devil is in the details. Once you peel the onion, the picture, the true picture that is, becomes abundantly clear. While the S&P 500 made new all-time highs this week, only 3% of the stocks represented by the S&P 500 made new 52-week highs. I repeat, only 3% of the stocks within the S&P 500 made 52 weeks highs, meaning that the S&P 500 is rising with very shitty breadth. Ask yourself a question. Is this sustainable or not? Matter of fact, it is the weakest all-time highs for the S&P 500 ever. And again, we have orgasms all over the place last week. It's like Oprah. You get an orgasm, you get an orgasm, you get an orgasm, celebrating the all-time highs readings in the S&P 500 and the Dow Jones. Yet behind the scenes, we have witnessed one of the biggest massacres in recent stock market history. Take a look at the retail crowd's favorite names. Plug Power, Fuel Cell, Palantir, pick your pick. These stocks are down in certain names over 50% from the highs. A lot of retail traders already got slaughtered. And here it is. U.S. retail trading flows have fallen almost 20% from a February peak, meaning that we have a lot of diamond hands out there holding the bag and waiting and waiting and waiting for a miracle. Are we going to have more victims from the retail side? They're all going to get seduced by the all-time highs readings, go all in, joining the market, and they will fall into the trap. And here are more headlines that you see during market bottoms. And I say that sarcastically, of course, for all of you Stroots out there. Miley Cyrus is now giving you some investment advice. Nothing is more important than investing in yourself. I want to spread ownership, among many other things that I spread, to as many people as I can. So I am teaming with the Cash App from Square to give out $1 million in stonks. Share your cash tag and favorite company name for your chance to own whatever. I think I lost 3 brain cells reading this tweet alone. But again, Miley Cyrus, bro, she says bye. Go all in, stonks. Download your Cash App and start playing in the casino. Miley Cyrus got your back. What a wrecking ball. But perhaps you're a little older and Miley Cyrus is still too young for you. You don't take her advice seriously. So perhaps I should find an older celebrity for you. What about Paris Hilton? Remember that one?
I don't get it. What does she do? She's super rich. But what does she do? She's totally spoiled and snobby. What does she do?
She's a whore.
Hey everyone! Sorry if I'm a little spent. I did a whole lot of partying last night with a lot of different guys.
Well, she was on CNBC talking about NFTs. And rumor has it that Paris Hilton is offering her STD reports as NFTs. And it will cost you $5 million. It's the future, bro. But once again, headlines that you don't see during market bottoms. Moving on to corporate-specific news, starting with AMC. Once again, one of those mania names. AMC is the future, bro. Blockbuster. Anyways, here is AMC Entertainment seeking investor approval for 500 million shares. They're about to dump an additional 500 million shares on your little heads with your little diamond hands. And of course, people ask me, what does that mean? It means that they're about to dilute the stock price because when you offer more shares, 500 million, that dilutes the stock price down. It's very simple. We have seen billions and billions of dollars of stock sales from different companies, whether we're talking about American Airlines, AMC, etc. And they're dumping on the little heads of the retail crowd, aka the dumb money. And I'm sorry to say that, by the way, because not all retail is dumb money, but we're talking about the zombies, the Robin Hoodiots. They buy stocks waiting for the moon, bro. Of course, companies know that the stock price is highly elevated. Doesn't make sense at all. So they take advantage by dumping more shares, raising more money. And by the way, this behavior alone saved many companies, chiefly airlines and the cruises. Had we known about this mania, perhaps we should have never issued stimulus to bail out the airlines and the likes. Perhaps we should have let dumb money bail out pretty much every single company you want to bail out. AMC, GameStop, cruises, airlines. Next time around, the government has to think about utilizing dumb money to bail out companies instead of using the taxpayer money. What about the evil empire of Amazon? Amazon reportedly explored opening discount stores to offload unsold electronics. Now that they have destroyed all of the small businesses, brick and mortar, the field is wide open for the evil empire to have a monopoly over the brick and mortar retail business. I know, but Amazon got to where it is because Jeff Bezos is smart and you're just jealous. I know, because the fiscal and monetary policy had nothing to do with the rise of Amazon, right? Once again, plenty of heads where the sun doesn't shine. Moving on to Comcast. Comcast may pull Universal movies from Netflix to boost its Peacock offering, meaning that Netflix has to stand on its own feet. And this is the streaming war, by the way. Every company on its own, meaning that every company will have to rely on its own original content. Creating that original content will cost billions and billions and billions of dollars, shrinking the margins for these companies. It's a streaming war. And let's remember what legendary investor Peter Lynch said. When there is a war, you don't buy the stocks involved in the war. Netflix, Disney, Comcast, to a certain extent, Viacom, whatever. You buy the bullet stocks. And here is the homework for you. And you gotta turn it, by the way. Professor Maverick doesn't give A's easily. What are the bullet stocks in the streaming wars? Once again, give me a list. Give me tickers. Give me tickers or give me death. I want tickers. That's the homework. Give me tickers of bullet stocks in the streaming wars. For example, I'll make it easier for you. In the EV wars, the bullet stocks are chips, materials, the likes of lithium and cobalt producers, etc. Good luck. What about Apple? Apple will reportedly use Tesla battery packs to store energy from a solar farm in Northern California. And speaking of the Soufflé has been on a roll this week. Good news after good news after good news. And here it is. Tesla reports 180,338 vehicles produced with 184,800 cars delivered in the first quarter of 2021. And the culties, of course, are having a massive orgasm. Look at Tesla, bro. The future, bro. It's gonna kill everybody. Monopoly, robo-taxis. So let's shed some light here whether these numbers from the Soufflé are good or not. Here are the major automotive producers in the world. Toyota, VW, GM, Honda, and Ford. Let's see how many cars they produced in 2020, or they sold, shall we say. Toyota, over 9.5 million vehicles. VW, over 9.3 million vehicles. General Motors, over 6.8 million. Honda, almost 4.8 million. Ford, 4.1 million. Big numbers. And here are the valuations for each company by the end of 2020. Toyota at 216 billion, VW at 91.5 billion, General Motors 57 billion, Honda 49 billion, and look at poor Ford at 34 billion. Now, let's divide the valuation of the company with the cars they produced in 2020. We get 22.6 thousand for Toyota, about 10,000 for VW. What about General Motors? About $8,000 per vehicle if you divide the company's valuation by the cars it produced. Honda, about 10,000. Ford, about 8,000. So what about the Soufflé? Because the Soufflé is valued more than all of these companies combined. Meaning, perhaps the Soufflé is producing more cars than all of these companies combined. Let's see. Here it is. The Soufflé produced about 500,000 cars in 2020. Meanwhile, the valuations of the company, $597 billion. And when you divide that by every vehicle Tesla sold, you get 1.19 million per vehicle. So every Tesla car is worth $1.2 million. Are you insane or what? But you know, I am an open-minded guy, and I am willing to debate Soufflé enthusiasts, aka the culties. I'll debate you, I'll sit down with you 15 minutes. Coffee's on me, drinks, whatever you want. I want you to look at this slide and justify for me rationally with the facts that the Soufflé should be worth more than all of these auto manufacturers combined. And God forbid, you mention robo-taxis. I will grab you and choke slam you right on the table. Don't you dare bring robo-taxis, because where are the robo-taxis? I thought they were coming by 2019, according to your cult leader, Reverend Elon Musk. Where are the robo-taxis? And by the way, are you surprised why I bought Ford stock in the beginning of the year? It is the cheapest deal out there. But the EV mania is not limited to the Soufflé. We have other Chinese names, the likes of NIO, Xpeng. So let's see how they did during the first quarter. Xpeng said Thursday it delivered 5,102 cars in March, beating implied deliveries of 4,262 cars for that month. The company delivered 13,340 vehicles in the first quarter. But somehow Xpeng is worth more than Ford. Sounds rational, isn't it? What about NIO, the biggest mania of them all? NIO announced deliveries of 7,257 vehicles in March, marking 20,060 cars for the first 3 months of the year. Yet somehow NIO is worth more than General Motors. I know, but it's the future, bro. And they're gonna do this and they're gonna do that. This is crystal ball investing. You're investing as you're sitting down with a crystal ball and you know exactly how the future would look. Good luck. Back in 2000, they said, buy Qualcomm because Qualcomm is the future, bro. It's going to be one of the biggest companies. They pushed the valuations to insanity levels. And guess what? Indeed, Qualcomm became one of the biggest companies in the world. Their chips are pretty much in every single phone we use. But it took Qualcomm over 20 years to surpass the highs from the dot-com bubble. Stock market investing is not about the future, bro. It's about what price are you paying for the investment. Let's do Li Auto. Li Auto had not released first quarter figures as of Friday morning, Beijing time. The company's forecast in February it would deliver around 11,000 vehicles for the first quarter, or fewer than 4,000 vehicles a month. Once again, take a look at the valuations for Li Auto, $22 billion. But I know it's the future, bro. So let's price in over 10 years of price appreciation right off the bat, without even knowing how the landscape of the EV industry will shape out to be, and what role will each of these manufacturers play in that future. Moving on to luxury auto sales, specifically from Lamborghini. While auto sales as a whole have suffered from factory shutdowns and other disruptions due to the pandemic, sales of super expensive cars finished 2020 at a blistering pace. And once again, I keep sharing my anecdotal evidence, at least here where I live in Southern California. I do have a friend who works in a luxury dealership, and we're not talking about an Audi dealership either. We're talking about the kind of dealership that Kylie Jenner shops at. And I did notice the increase of luxury car numbers roaming the streets. I'm seeing more Porsches, more Aston Martins, more luxury cars roaming the streets. So I did ask my friend, what's going on here? Did you guys sell more cars this month? He said that these cars been selling like hot cakes. Their hottest year ever. You know that new SUV from Rolls-Royce? They had about 7 or 8 of those. They were all sold right away, above the sticker price, because the buyers were stampeding and they were offering cash offers, as if it was an auction. And they sold all of these SUVs. This is exactly the kind of economy that the Federal Reserve is proud of, because they created this kind of economy and this kind of inequity where we have massive gains in crypto, stocks, real estate, the assets of the wealthy, with exception of crypto, of course. Crypto is the poor's man gold, even though the people who are holding the largest holdings happen to be the same people who are holding stocks and real estate. Just so you know, by the way, crypto is the poor man's gold on paper. But in reality, it's not. But anyways, they're using their gains to buy luxury cars. And therefore, we're seeing luxury car sales exploding higher. And it's not just anecdotal anymore. Record sales and instant growth. Bentley, the 101-year-old ultra-luxury car brand, had its best year ever last year, despite the pandemic totally shutting down its factory in England for about 7 weeks. Even after the factory reopened, it was running at half its normal pace for 9 more weeks. And that is contributing to the mania, by the way, the stampede, because some of these companies are not producing new cars. So whatever inventory you have right now in the market, that's it. You want to get your Bentley, you better get it right now. First come, first serve. And they're taking cash offers above the sticker price. But hey, where is inflation? I don't see inflation anywhere. Moving on to the heat map analysis, and let's see what took place this week. Looking at the heat map for the week, can we extract any theme just by looking at the map? Of course not, because everything got pumped higher. We had portfolio rebalancing that we saw buying across the board. Whether we're talking about inflationary, de-inflationary, reopening, stay at home, it didn't matter. It was the tide that lifted all boats, with very few exceptions. So let's move on to the ETF map. Perhaps we can extract more information here. For example, we know that the technology sector managed to outperform, but which part of the technology sector precisely? The answer is, take a look at the XLK, the overall technology ETF, up about 4.71%. But take a look at the SOXX, up almost 9.5%. Likewise, the SMH, up almost 10%, meaning that the strongest part of the buying that took place this week happened to be in chips. Another big outperformer for the week was the XOP, the oil ETF. So once again, you have chips and oil rallying together. Is there a theme there? Of course not. Meaning that the market will take the time this week and beyond to sort the move from last week. Does it make sense Does it not make sense? And once again, which route are we going to settle in? The inflationary or the deflationary route? Because as you can see, the picture is mixed for this week, yet the clear winner is the deflationary trade. Because take a look at the Chinese ETFs. The FXI, the MCHI, all closing with massive gains for the week. The Chinese ETFs get punished when yields rally here in the US, the Treasury yields. This week we saw yields diving lower, a pause in the rally, and that was good enough for Chinese ETFs to bounce higher. Let's take a look at the different themes of the market. Perhaps we can get more information doing it this way instead. What about the reopening stocks? Mixed picture, but overall in the green, meaning that the reopening trade is still hot. Big gains for names like Live Nation, Molson Coors, Coty, Planet Fitness. What about the inflationary trade? What do we see here? Also mixed picture, but happen to be mostly in the green. Big gains for US Bank, WC Carey, Boeing, Alcoa, Hubble, UPS. Dear, meaning that we did not see a rotation out of the inflationary trade. And this is very important because we had portfolio rebalancing. And portfolio managers are saying we're not rotating out of the inflationary trade. So what did they do? They bought the dip in the inflationary trade. Here are some of the gains. For the inflationary names, massive gains for names like Nvidia, Okta, Snapchat, Peloton, Shopify, Square, massive gain over 10%, Tesla, Docu, all closing in the green. Is that sustainable or not? That's the $1 million question. It will all depend on how yields react on Monday's opening. To shed more light, let's visit the charts analysis starting with the SPY 30 minutes chart. Once again, we are still in the series of higher lows, right after the big rebound. Now, I am highlighting for you a few gaps in the yellow circles that you see here, meaning that if we go down, we will have to close some of these gaps. And those becomes points to watch of how will the chart react once it closes the gap. Closing a gap and bouncing higher is bullish behavior. Closing a gap and then diving lower is very bearish behavior. Now, can the SPY continue to rally higher? Yes, it can, leaving those gaps open. But at some point, it will have to go down to close some of these gaps. Remember, 99% of gaps are filled. Is there anything that the 30 minutes chart of the SPY can tell us here? Of course not. The sky is the limit. The chart on a technical breakout, and until and unless we see a reversal or a pullback, that we don't have any valuable information from this chart alone. Therefore, we're moving on to the daily chart of the continuous contract for the S&P 500. We've been talking about the potential breakout from 3,960. We talked about the bull flag consolidation. And as you know, every time you consolidate below or at a resistance level, a major one, you are building energy to crack above it. We saw that happening with the US dollar at the level of 92, and now we are seeing it in the S&P 500. We finally have that impulsive breakout higher. We are correcting the lower divergence in the RSI. So is there anything bearish to see here in the S&P 500? Not for now, not at all. If anything, the chart is bullish. And if we are about to see the inflationary side of the market outperforming once again, financials, industrials, materials, energy, defensives, then the S&P 500 should go higher. But bear in mind, because we always have to keep a check here, from the weekly chart perspective, we have a rising wedge. And kids, grab your technical analysis book and see what a rising wedge means, because it usually breaks to the downside. About 20% or so of the rising wedge cases break to the upside, but usually they break to the downside. So we are still watching how will this consolidation resolve itself. And we are running out of time. The resolution is imminent out of this wedge. It could happen this week. So what are you saying, Maverick? Are you saying that the market could go up or down? Wow, what a revelation. No, what I'm saying is, looking at the daily chart, we are breaking out all-time highs, and if the inflationary trade is still in favor, the S&P 500 will go higher. But keep in mind that we have a rising wedge consolidation from a weekly perspective that is usually negative and plays to the downside. So tread the waters carefully. Play the market as you see it right now. It is bullish, but perhaps it's not a bad idea to buy some protection while it's cheap. The VIX closing below 20, meaning that puts specifically for the S&P 500 will be dirt cheap Moving on to the Qs, 15 minutes perspective. What do we see here? The Qs closing above 223, which is the very important support level above 313. And we said before, if you want to escape the gravity of 313, you gotta capture 323 and retest it as support before you're out of the woods. The chart broke above 323 and now it is support from a weekly basis. That's point number one. Now comes the retesting part. That could happen as soon as Monday. And oh boy, if that test fails, the test of support, then the full vengeance of the gravity of 313 will be on display. Mind you that the Qs managed to escape the gravity of 313 the dirty way by using the low volume shortened trading week to escape, creating all of these gaps. Not one, not two, but three gaps. And now Mrs. 313 will wake up. Mr. Qs is nowhere to be found. Not only that, he's upstairs at Mrs. 323. How do you think Mrs. 313 will react? What about the continuous contract of the Nasdaq? From a daily perspective, we talked about the reverse head and shoulder formation. We said that that's on the table so long as the chart does not close below 12,766 from a daily basis. That never happened, and now we are seeing the reverse head and shoulder formation playing out. But something very interesting happened during Friday's session. Initially, after the release of the jobs report, the Nasdaq blasted higher. But as we started processing the information, this is way better than expected. And perhaps that should push yields higher and increase the possibility of tapering. We saw the Qs futures closing at the lows of the session. Meanwhile, Treasury yields managed to close above 1.7%. So is this a telltale of how this upcoming week will play? The Nasdaq giving up the gains and yields surging higher? I believe so. And what about the NDX? The big Nasdaq, from a weekly perspective, we have a bear flag formation. To undo the bear flag, the chart has to do what it's done back during the September correction of last year, which is closing above half of the pole of the flag. In this case, it is 13,414. If the NDX close above that level from a weekly basis, then the bear flag goes out of the window. We have another rally coming for the Nasdaq. But for now, the bear flag is still intact, and so long as yields continue to surge higher impulsively, the Nasdaq is out of favor. What about the IWM, small caps? 15 minutes perspective. We have that big rebound still going on. For now, it is nothing more than just a mere rebound because we don't have a formation of a clear bullish pattern. For example, higher highs, higher lows, we still don't have any of that yet. We also have a gap at 218. So at some point the chart will have to go down and close that gap. 218 happens to be a major support line that has to be retested before creating another rally. Zooming out to the rut from a daily perspective, likewise, we have a bear flag formation that could play to the downside unless and until you close above half of the body of the flag pole. That happens to be 2,264. Doing so will confirm that the current formation we're seeing is yet another formation in the series of higher highs and higher lows, meaning that the bullish trend is still intact, but reversing before closing above 2,264 will make a lower high, and we will be on the lookout for a lower low. If that happens, then bye-bye to the bullish trend in small caps that started all the way in November last year. And what about the Dow Jones? Weekly perspective. Breaking above the resistance line, a very major resistance line, and the Dow Jones for now is the most bullish chart in the market. But here are two things you have to keep in mind. You see the yellow circle showing you a gap in the Dow Jones? 1,000,000%. Now 100, now 1,000, 1,000,000%. This gap will be filled, meaning that the Dow Jones will go down to fill that gap. I formally challenge you to find a gap in the weekly chart of the Dow Jones just like this that wasn't filled. You have to go all the way back to the 1990s, meaning that if we are playing probabilities, the chart of the Dow Jones will have to go down and close that gap. And here's another way to look at it. The healthy way is going back to retest the resistance line from which you had the breakout, retested for support, and then bouncing higher. This is what you want to see as a market bull. Moving on to the dollar index, the series of higher highs and higher lows remains intact, but we are facing the resistance line in yellow, which coincides around the number of 93. So far, no bearish formation whatsoever. But if we are reading the tea leaves, are we seeing this? A bear flag formation in the dollar index, which will lead us lower. This is at least what gold is saying. Here is gold, double bottom, surging higher. Next destination is 1750. And if gold is about to rally, then the US dollar is going down, because we know that yields are not going down. Specifically after the jobs report we got on Friday, gold has two enemies, yields and the dollar index. At least one of them should back off for gold to start to rally. What about oil? XOP, the oil ETF. Last time we talked about this chart was last year, right before the Biden's election. And I showed you the descending line and the imminent breakout, and I mentioned that I am bullish on oil because unlike the consensus that the Biden administration will destroy oil stocks, yada yada, I told you that the Biden administration will be the best thing that ever happened to oil stocks since 2014 because they will choke out the domestic supply of oil. Right away, we see the impulsive breakout for the XOP. We have the resistance line at 96. We are at 85.5, so there is room for the XOP to rally all the way to 96. What about the monthly picture for the XOP? Take a look at the MACD. If you've been trading this chart based on the MACD from a monthly perspective, you did pretty well because the chart is reacting exactly in correlation with the MACD crossings, up and down. We had the big crossing in the MACD creating green impressions in the histogram, and we just started, meaning that there is plenty of room from an RSI perspective, from a MACD perspective, in the monthly charts for the XOP to rally significantly higher. We will have pauses and breaks, but the monthly chart is saying you're probably insane if you are not long the XOP. What about Bitcoin? We have the crossing in the MACD just slightly. We're waiting for confirmation, and we are waiting for correcting the negative divergence in the RSI, meaning that there is a big breakout about to happen in Bitcoin. Remember, the risk of rejection is still here, and of course, any moment the SEC could announce something that crashes Bitcoin. Yet from a technical perspective, if you were to lay a bet right here, looking at this chart, which direction are you going to bet on? Up or down? In my opinion, I'm betting for higher prices. And therefore, let's take a look at the chart of Riot blockchain. Because Bitcoin is expensive, not everybody wants to trade Bitcoin, so you can trade it via proxies. What is the chart of Riot blockchain doing? First of all, there's a massive gap right before the impulsive breakout, and that will be filled in time. But for now, we have a wedge consolidation, and my bet is that we will go to the upper limit of the wedge before reversing lower. Back and forth until we see a breakout one way or the other. So the risk versus reward says buy call options on Riot blockchain. And this is exactly what I did. I don't know if it's going to work or not, but knowing how karma usually treats me, perhaps it's not going to work. Perhaps Riot blockchain and Bitcoin will crash this week just because I decided to make a bullish bet on Bitcoin. But hey, perhaps I have ulterior motives here. Perhaps I want to crash Bitcoin, and therefore I am sticking my neck out there, so for all of you Bitcoin bears, specifically Peter Schiff, you are welcome. Moving on to Treasury yields, what do we see here? I'm updating the chart for you to the latest reading. Nothing is going on here. The series of higher highs and higher lows remains intact, so we are expecting higher readings for yields. What about bond prices, the TLT? From a Fibonacci perspective, we have a positive closing, but take a look at the RSI. We pretty much fixed the oversold conditions, but the chart barely rallied. And this is not good because when you want to fix the oversold conditions in the RSI, you want to see a big pop, a big bounce higher, marking a bottom, and then building a rally slowly but surely. This is not what's taking place in the TLT, yet we don't have a conclusion one way or the other. And let's represent the bullish case because the bearish case is already represented. I just said the yields should continue to rally higher. But is there a bullish outlook for the TLT from a technical perspective? Could be. Here it is. We had a series of lower highs and lower lows. We just made a higher low. And the question is, are we going to start marking a higher high? And if that's the case, then we are reversing the downward trend, and we should expect the TLT to surge higher. So this is one of these things that I'm watching for. Leaving your bias out of the window and let the chart speak. If the chart manages to close higher, making a higher highs, then we do have a reversal. But if the chart closes below 134.5, then whatever that bounce was, it's over and the TLT will continue to dive lower. What about the VIX? The talk of the town. Closing below 20 decisively. A massive breakdown, and this is porn to the perma bulls, the likes of Tom Lee, for example. They're looking at this chart and jerking off because according to them, the breakdown in the VIX closing below 20 is the green light for the stock market to have an impulsive rally higher. We're not talking about a small rally. We're talking about one of the biggest rallies we've ever witnessed. Here is the catch, though, that will perhaps catch most off guard. What is the closing on Thursday? 17.3. Now, let's zoom out and visit the famous gap in the VIX weekly chart. What is the reading for that gap? Are you ready for it? 17.3. Exactly where the VIX closed, meaning the VIX is saying pretty much, hey bulls, you've been bugging me about the gap below, and that the VIX cannot sustain the rally higher with a gap like this, etc., etc. So here's the contrarian view. Is the VIX saying, okay bulls, here's the gap you've been talking about over and over and over again. I just closed the gap, and now I should have a clear path to explode higher. This is the contrarian view. What about Apple? 1 hour chart. We do have a bull flag consolidation. If that plays out, then we should be able to visit the 125 resistance, perhaps turning it into support. The problem is that we left a gap open at 120, which happens to be the center of gravity for now. But we also have a gap open at 117. Apple is one of those charts that happen to be technically sound. What does that mean? It means it doesn't leave a lot of gaps open. So rest assured, the gap at 120 and the gap at around 117 will be closed. For now, we have a bull flag consolidation. Let's see how the chart reacts at 125. A harsh rejection will mean that the center of gravity will win, the center of gravity that is 120. So if you see Apple getting rejected from 125, then that would be a signal to place a short on Apple, playing it all the way down to 120. What about the weekly picture? No markings or annotations by me. What do we see here? Here's the bear flag consolidation from a weekly perspective. Once again, the short-term perspective versus the long-term perspective. And you know the deal. To negate the bear flag, you have to close above half of the body of the flagpole. For now, we have negative formation from a weekly perspective. And lastly, what about the Soufflé, Tesla? Let's start with the Fibonacci retracements. I was all in, Team Soufflé, willing to buy calls if the chart closed above 679. It had every tailwind to close above 679. It failed to do that, and it managed to reverse the gains, closing in the red during the last trading day of the week. That's bearish. That's a bad signal. Will it prohibit the chart from rallying entirely? Of course not, because we have an increase in call option buying, as you saw during Thursday's session, betting that the deliveries number will push Tesla stock higher. So once again, we will be watching for 679 and the next level, which happens to be 720. But here is the big picture for Tesla. Weekly perspective, once again, a bear flag consolidation, which should be resolved to the downside. Now, for all of you Soufflé bulls, I can keep the hope alive for you and show you a potential for a bullish scenario. Here it is, wedge consolidation, the likes we saw back in September of last year that was resolved with a rally higher. Now, I can already hear you. You're saying, oh, you're confusing us. You're showing a bearish chart and then a bullish chart. What's going on here? The technicals remain bearish in Tesla. I'm just showing you a market symmetry perspective, which happens to be bullish. Market symmetry is interesting, but it's not science. I'm just trying to get the Soufflé fans to get off my back. Moving on to the conclusion of this video. What do we have in the economic calendar for this upcoming week? We got the manufacturing readings. Now we're going to get the services readings. On Monday, we have the services PMI and ISM. That will be very important. Watch out for yields, because if the number comes out hotter than expected, with prices paid way higher than expected, then yields will surge higher. Then on Wednesday, we have the FOMC minutes. That will be very important to watch. Thursday, per usual, we have the weekly jobless claims. And on Friday, we have the PPI index, giving us an official pulse on inflation. And we know that the numbers will be cooked. It'll be a difficult job, given all the information and the facts that we have on our hands. But never underestimate how good the Bureau of Labor Statistics cooks are. Anyways, back to the main question. Which route would the market take? This week, the market is saying, I'll take both routes. We're going to pump everything higher. We know that this is not a possibility given the macro outlook. The market will make its mind given the facts, and the reasonable conclusion is we will resume the route of higher yields with the reopening, reinflationary, and value stocks in favor. Anyways, thank you for being with me in this long video. You've been complaining to me, oh, but you haven't produced any videos in this long weekend. What's going on? So here I am. I'm producing a long one, a big dump. I'm taking a massive dump on your little head. So enjoy. I hope this was helpful to you, because that's all I got for you today, and I will talk to you again tomorrow. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.